Tech, by far the top sector in 2023. It gained more than 56%, with a lot of that concentrated or connected to the performance of the Magnificent Seven stocks. As we get ready for the first opening bell of 2024, we're seeing a little bit of profit taking in those big tech stocks. Let's talk about some top tech picks with Dan Niles, founder and portfolio manager at the Satori Fund. Dan, it's good to see you. Talk about your approach to this year, because, you know, we obviously have a lot of calls that the Magnificent Seven probably were overrepresented in terms of leadership last year. Some of that's started to change in the last 2 years. How are you setting your game plan for 2024?
Yeah, so the way we're approaching this next year is we've got a combination of offense and defense. And on the offense side, we've got two of the Magnificent Seven as top picks for 2024. And those two picks are Amazon, which tends to gain share during a recession. But we also think it's got a lot of profit margin expansion potential going into 2024 based on all the capacity they built during COVID. And the second one we think is Meta. That was actually a top pick of ours for this past year, and it was the second performing name in the S&P 500. But if you look at it, the revenue growth was 15%, but you can get it at just a 25 multiple. You compare it against a name like Apple, for example, which got downgraded today by another firm, and Apple had negative 1% growth this past year, and you can buy that at 30 times. So I think Meta is a good defensive play in that example as well. And then we've got two ETFs in the biotech ETF, XBI, KWeb as well, which has been underperforming for 3 years, just like the biotech ETF. And then we have Texas Instruments, where we think, you know, the stock was only up 3% last year. Yes, the semiconductor index was up 65%, but TI went into the downturn before most of them. We think they're going to come out of the downturn before most of them in semis, and the stock should be able to relatively outperform. So we've got a lot of defense in the portfolio, and we've got some offense with two of the Magnificent Seven.
I'm interested in your defining Meta as at least a relatively defensive bet fundamentally, because if you went back a year ago when you did pick it, the story was, you know, the stock has been beaten down. The street doesn't really believe in the company. They're doing this year of efficiency. They're going to be getting margins way up. A lot of that has come to fruition. It feels a little more like a consensus pick today. People really have been riding this rise in the stock this year, but you still think there's more left in like the multiple expansion story, perhaps?
No, it's not so much the multiples, but you bring up a good point. If you look at last year, it really was all about the multiple. I mean, you take Apple, for example, which was up 45% or so, and you look at the EPS. The EPS for the December quarter, which they'll report in a couple of weeks, is down almost 10% from where it was a year ago, because the numbers have been coming down all year. What's really driven the stock, to your point, for the Magnificent Seven in general, is multiple expansion. If you look at Meta, however, I think you've got a couple of things going on. Number one, they're using AI really well to increase the monetization of their ads, and they're also using it to increase recommendation of their videos. But don't forget, we've got an election coming up, and this is probably going to be one of the most hotly contested elections we've ever seen. So a lot of money is going to pour into the online ad market, and so that should help drive ad pricing up, which should help Meta. And then from a outside chance, we've been talking about glasses and mixed reality and all of this stuff for a really long time. And Meta's collaboration with Ray-Ban, where they're introducing something you can wear on your face that you might actually wear, unlike the ski goggles that Apple introduced at $3,000. You've got something that might have a chance, outside chance, when you get to the end of next year, of being the way that people choose to use AI in something that they can just wear and just say, hey, Meta, and get it to work. So that's why, we thought long and hard about these set of names, and I think Meta had a nice combination of defense as well as some offense in there. And you're right, it did great last year when we picked it. Everybody hated it. Now everybody loves it now that it's tripled. But I think it still has a good chance of doing well because it does have a good valuation at a reasonable growth rate.
The KWeb, the Chinese internet ETF, is that really purely a mean reversion thing? It's been down so long, it's got to actually pick up here, and it's obviously a very, very disdained area of the market.
No, I mean, this was the one I had to think about the most, quite honestly, because every time you think that the Chinese government has stopped beating up on these companies, they come out and they do something else. But from my perspective, actions speak louder than words. And the one thing I have noticed is that, China has started to step in and buy the ETFs around their stock market very recently. And that really started in August, really picked up steam in December. Because if you look at KWEB, it's down 2 to 3% below the lows set during COVID, below the lows set during calendar 22. Now, if you look at the fundamentals, though, you can take the three most recognizable names in the KWEB, which is Baidu, Alibaba, and Tencent. You can buy them at 13 times PE for off of 24 numbers. For comparison, the Magnificent Seven, you're paying 34 times. Now, if you say, well, that's all about growth, it really isn't, because if you look at the last 3 years since China really started going after these companies, the revenues for those three that I mentioned are up 33%. The stock prices for those names are down 53%. You compare that against the Magnificent Seven, and you've got revenues that are up around 50% plus, but you've got stocks that are up 65%. So that's a very big valuation discrepancy between 13 times for BAT, as they call them, Baidu, Alibaba, and Tencent, versus the Magnificent Seven sitting at 34 times. And I think the fact that China stepped in to start defending their stock prices at a certain level, that's kind of what pushed me over the edge on this versus some other names that I had been considering.